Is there returned appetite for risk? Yes, there is. In fact, the EIU report has projected investor sentiment to improve in 2010 and 2011. The overall business confidence index being tracked by our central bank has reverted to positive territory for the first time since the third quarter of last year. We expect this trend to continue. But at the end of the day, if the global financial system does not learn from its mistakes and embrace reforms, we will all lose more than we have already. Therefore, what remains to be done regarding financial sector reform? As we move forward, we need to look closely at the values, or in some cases, complete lack of values, that led to the collapse of the financial system. A problem in one financial market can quickly become a problem in many others. We must work cooperatively to contain that contagion, or better yet, provide the inoculation that will keep it from happening. As we are all aware, in the period leading up to the current crisis, there were many cases of inappropriate and misunderstood risks. This was compounded by financial engineering and disproportionate risk-taking in the financial sector that's motivated by the pursuit of short-term profits. It was also compounded by the emergence of unregulated and opaque financial instruments. In the Philippines, we have implemented extensive financial and economic reforms. More can and should be done, but my biggest concern is with the lack of progress on global reform. Here we are, a year after the Lehman Brothers collapse and subsequent economic contagion, and already some of the same firms that got us into this mess are pretending it never happened. In the euphoria of the emergence of the green shoots that we all hope are harbingers of economic rebound, we are losing sight of the calls early in the crisis for the overhaul of global financial regulations. Governments the world over must insist that we come to grips with what happened and make sure we put in place rules so that it doesn't happen again. We cannot expect the poor in places like the Philippines to lose their shirt because someone on Wall Street made a bad bet. It is my duty to our people to insist on drawing attention to the need to bring sense to a global financial system that is clearly not suited to the complexities of the current global challenges. That is why I am stepping up the call for action for governments to come to grips with the need for a new global financial regulatory regime. The G20 leaders in particular will be meeting soon. They must take strong, decisive action to push forward tough new regulations. What about in the Southeast Asian region? What policy initiatives do we need? As we did in 1997 and 1998, the region must continue to learn from what happened this time in order to make ourselves even stronger. Our region has made substantial progress with the Chiang Mai initiative that will provide liquidity support to governments in our region. We have taken it upon ourselves as a region to be more self-sufficient. While decoupling from the US and Europe cannot and probably should not occur, that doesn't mean we shouldn't take more firm steps to control our own destiny. We must continue to press for closer cooperation and consultation. The global economic crisis has been a long nightmare for many people and many nations. The poorest, many of them in emerging market economies, have been affected the most. The headlines scream about Wall Street, the failure of government regulation, and the noise of lost wealth, but they should also scream about the need to ensure that the world's emerging markets, many of them committed free traders, are given the support they need to ensure that any economic rebound is truly inclusive and truly global. To what extent has the experience of the 1997-98 financial crisis helped governments cope with the storm? Painful economic slowdowns are not new to the countries of Southeast Asia. As you are all aware, our region went through a gut-wrenching financial crisis more than a decade ago. In retrospect, it seems very much like a dress rehearsal for today's turmoil. Companies defaulted, banks collapsed, stock markets tanked, and economies shrank at double-digit rates as foreign investment slowed to a trickle. In addressing this crisis, Southeast Asia dutifully swallowed the bitter medicine of austerity. It devalued currencies and worked off debts, while banks restructured and companies patched up balance sheets. Asia has benefited, if you will, from the dreadful experience of the 97-98 Asian financial crisis. Thanks to the lessons learned by that crisis and the actions taken by the government since then throughout Asia, as a nation and a region, most of us are much better prepared to cope with the challenges we have been facing over the past year. The previous crisis showed Asian governments that it was important to rebuild foreign exchange reserves. It encouraged major Asian companies to deleverage their balance sheet, restructure their businesses, and improve their cash flow. It led domestic banks to cut non-performing loans, improve liquidity, and consolidate the industry. This augurs well for our regional trading outlook and for the development of the ASEAN regional trading bloc we will have in place by 2015. It also speaks well for the prospects of our emerging market economies. Because of that experience, the prospects for growth in Southeast Asia today are some of the strongest in the world. Regional and global investors, I believe, will step up their risks in our region because they know we have been through it before and that we emerge stronger than ever. But will national rivalries preclude meaningful progress toward regional political or economic integration? To answer this question, I would look at what we have achieved rather than what is left to be done. ASEAN has made significant progress towards integrating our economies, breaking down trade barriers, and asserting macroeconomic control over our regional economies. Of course, there are always issues, national issues and regional issues to overcome, but they are not greater than the threats to our region from global forces. But in spite of the need to urgently address global economic policy considerations, my outlook for emerging markets is very positive. The best opportunities for the medium term are found in Asia for several reasons. First, we have a healthy financial system that remains stable and ready to support growth. Our region's banks are virtually free of toxic assets. They have not needed government bailout money. Years of trade surpluses and high savings rates have contributed to record foreign reserves. Debt loads for governments, corporations, and consumers are a fraction of those in the US and Europe. Inflation and interest rates have fallen rapidly as our central banks have deftly managed this fluid global environment. Second, while each market is different, the nations in our region represent a varied mix of opportunities for any investor. The governments in our region have an ongoing commitment to policy reforms, which are crucial in any investment decision. They are also committed to address the challenges in the bureaucracy and infrastructure that will shape the direction of their economic growth over the next decade. Most of emerging Asia is addressing these areas, and we will return to high rates of economic growth. Because of that, now is the time to prepare for the significant opportunities that will accompany this growth. There is no better emerging market to take advantage of that growth than the Philippines. I encourage each and every one of our emerging market investors to consider the Philippines as you look for the best trade and investment opportunities that will come out of the return to high levels of economic growth. Thank you.